can you hit page 1 for me? All right. So we're going to go through these one by one, but everybody agrees that if you are an entrepreneur and you want to present any idea to an investor, you at least have to have this type of documentation. And so the first one is the business and marketing plan. So Summer, do you want to talk about your experience with business and marketing plans?
Sure. So anytime I join a new startup, brand new company, you have to assess what the business model is, meaning how you're going to make money. That's very important. A lot of entrepreneurs miss the how we're going to make money part. So talking about how you're going to make money, and then explaining, as you said, how you're going to scale that up. I'll use the opportunity here specifically to talk about, since we're talking about funding, to reference how to connect that for an investor. I think specifically in my experience working with investors, specifically in Mexico, and then also getting investment from the US to go to Mexico, one of the things that you really have to overcome that is different than other startups or other folks, specific to this community, is an education component. So not only do you have to explain your business, but sometimes you also have to connect the dots on where the actual opportunity is, especially if there's a regional component to what you're doing. If the opportunity is because it's Latin America or because there's a Hispanic component, you need to explain that. And so as it relates to the marketing plan, sometimes you might take something for granted that is not obvious to an investor. So you really have to make sure all of that is documented and clearly communicated in a plan. The second point I'll make as it relates to investment, and this point here, is that a lot of, within this community, a lot of companies or ideas that are started look a lot more like a small business. And the difference between a small business and a startup is a small business will grow over a long period of time. And the anticipation for a startup is that you go from like maybe nothing to something really big, millions, tens of millions of dollars potentially. So sometimes we think too small. We need to actually think bigger, and we need to be realistic about it, but we have to have a bigger picture in mind in order to be attractive to an investor. All of that comes into play when we're talking about the business model and the marketing plan, right? Because that's part of the story that you're telling, is how big is this opportunity, how will this opportunity make money. All of that has to be in what we typically have as a pitch deck, a presentation of some kind that you're presenting to the investor. Those are some of the key pieces that I see missing in this community sometimes. We think too small and we forget to educate the investor on where an opportunity is that they may not typically be as familiar with, in terms of just, you talk about seeing 1,000 startups, you start seeing certain patterns, right? So when something doesn't fit the pattern, now you have to assess it and analyze it an extra couple of steps. If you make that easier for the investor to understand, you have a higher likelihood of getting investment as a result. For sure.
So Eric, before we jump to you, we have a perfect case study that just happened to land in my lap tonight, where I asked them, what is your business? And they said, well, we got kind of like a mom and pop translation business. It's not really all that scalable. And I said, well, do you know that there's a guy out there, he's in Pittsburgh, if you could believe that, and he's a Guatemalteco, and he invented this thing that's called the CAPTCHA. And he did really, really well with the CAPTCHA and the reCAPTCHA, and everybody's computer uses it. And then he went on to start a company called Duolingo. And they've received bazillions in venture capital. And so oftentimes, like Summer was saying, I myself am that way. Like, I like small problems, I like stress-free, I like to soak, I don't want any problems in my life. I associate with high net worth individuals that like big problems. But if we want to scale a business and we want to attract venture capital, we have to sometimes think a little bit larger. Eric, is there anything you'd like to share?
Yeah, absolutely. To agree with everything that was said. To put an additional layer of complexity onto it, when you're building a company and you're selling a story from birth to exit, you're actually going through maybe 4 or 5 stages. So your business and marketing plan at stage 1, which is can you pay the bills and get anybody to support you at all, is a very different business and marketing plan. And your investor is going to be your family and friends, and I'll go through some stages. And so everything you do in that stage is very, very different. And you need to be able to prove that you can produce something that makes a dollar, right? And when you go to the second stage, which is usually an infrastructure stage, that investor is a different investor. They're expecting a return, so you have to think about how you're going to pay them back and how you're going to get more people to support you, okay? And then your next stage is a scale stage, and that is usually when the founders take a step back and they let somebody more experienced step in and build that company because they need a different network, different business and marketing plan, and the company is going to look completely different in that stage from the start of the business. And then you get into your money making, wealth creation, and exit preparation. So there is no single business and marketing plan. It changes all the time.
For sure. What doesn't change is that if you show up with an investor and you don't have a plan, you're not investor ready. So just make sure to keep that in mind. A technology roadmap is actually a very complicated document, but it provides that ability for you to scale and make it something that an investor would be interested in essentially because of their greed. They want to make money by investing in you. And so you need to have a technology roadmap. 10 out of 10 companies that I see are technology companies. Mechanics don't usually come to me with like how to open an auto shop or anything like that. So if you are trying to start a technology company, you need to have a technology roadmap.
And you can bring it more broadly by just saying roadmap, right? You see technology companies, so you call it a technology roadmap. Excuse me. But building off of what Eric just said, the roadmap is the point of showing how it's going to scale. So if it's technology, you want to build your MVP or your excuse me, choking. Minimal viable product should just show something works, right? And then you want to show that next step that you have the first customer, the first user, and then you want to show you have more and the partners. Whatever that path is that you envision for the company on how you're going to get from where you are now to that next point where you're making money for the investor and yourself and your customers, etc. That is your roadmap. And so it takes different stages and different steps to get there. When you are a startup or early stage, just early stage in any type of business, investors understand that you don't necessarily know where you're going to be 2 years, 5 years from now, right? The point of having a roadmap is 1, you have a plan, you think. 2, that you have a point of using the funds that they give you. If you go to an investor and just say, give me money, they're gonna be like, for what? Well, so I can build something. For what? Like, where are you headed, right? So number 2, to say what your use of funds are. And number 3, and this is important for a lot of investors, and probably Eric can speak to it better than I can, is the idea is that you want to give your investor an idea of how you think, right? So when I come in and I'm on day 1 in a company, I will start pitching to an investor where we're going to be in 2 years from now. Do I know where we will really be in 2 years from now? Things change, the company changes, we find a different customer, we pivot, a lot of things can happen. The point of having a roadmap beyond just having a plan is also to communicate to someone how big the idea is you have. Like you said, are you planning on making $50,000 this year? Are you planning on, making $5 million? Are you going to be around in 10 years? Are you trying to get the company acquired? All of that should be in a roadmap. Usually the way that I represented it is kind of a corporate development roadmap, which incorporates the technology milestones, and then a financial roadmap. And I match the corporate with the financial so that an investor understands what milestones are being reached for what investment, like chunks or pieces. So I'm gonna get some friends and family now to Eric's point, later on down the road, I'm gonna get VC funding maybe, or maybe you're not gonna get VC funding. Maybe you're going to have some sort of loan situation. There's lots of different mechanisms for getting funding. So taking this more broadly, you need to have a roadmap as a communication tool beyond just an operation tool.
Eric, anything you'd like to add there?
I'd like to emphasize that for sure. You know, the question you need to be able to answer with an investor is, how are you going to pay them back? And I don't know how many of the 1,000 you've seen.
We have another slide in here that is going to emphasize that for sure.
So that question usually stumps people because they don't know how to, A, they don't know how to answer it, and B, they're surprised that I'm even asking it. But if I'm giving you money, I'm not donating it to you. I want it back in like tenfold. So there's a lot of pressure as an entrepreneur to be able to answer that question. And with some good advisors, some good mentors, you should be able to answer that question as an entrepreneur. And actually, how many entrepreneurs are there in the audience?
Nice.
Like half-ish, okay? And then are the rest investors? How many investors?
No one's going to admit to that because everyone's going to flock to them.
I put them on the spot. And then the rest of you guys support the entrepreneur community, or okay, got it, okay. So as you go through the roadmap, you know, the one of the other things you could probably latch on to the financial and the technology is your advisor board and your actual board, right? Because people want to know that you're being supported by individuals who know the industry. The more industry experts you can get in there, the better. One of the 5 questions I ask the companies I'm going to invest in is, what are your industry ties and who are your strategic partners? If you don't have those, you're fighting the rest of the industry by yourself, and you don't have any proponents. What we did at MaxiaNet, and actually we have some teammates here. We have 4. So if you guys want to talk to them, we can later. What we did is we partnered right away. So we have a legacy company that essentially operates and buys and sells goods internationally. What were they missing? They were missing a sales force. So we created a sales force. The sales force works differently than an operational company, right? It's different overhead, it's different personalities, it's different technology. And so we created 2 different companies that use each other. And I used the legacy company to essentially pay and fund the creation of the second company. So that is probably a rare example, I would say, of an industry partnership that is like super solid, that is allowing a new company to get off the ground. So I would definitely emphasize the partnerships in your efforts.
For sure. So we're going to try to get through 11 pages of this deck, and each one of these is important enough for an entire talk all by itself, right? For the pro forma, the only thing that I'm going to say is, of the 1,000 startups that I've seen, the 2 things that pro formas always have in common is, 1, they're always bullshit, and 2, for the most part, they're like out of touch with reality. And so I get a lot of startups that are like telling me they're going to go from 0 to some number in the billions in a short amount of time, and it's not going to happen. And so anchor yourself in reality when you go to put together a pro forma. Use all these other documents to show how you're going to get to that stage later on down the road.
That was excellent.
10 more slides?
Use the funds. How are you going to use the money? I think Summer touched on that really nicely. A style guide is for sort of the brand and the marketing aspects of the business. It's pretty expensive to get a well-done style guide, but if you're serious and you want investors to take you seriously, it helps a lot. And lastly, incorporation. So incorporation, I cannot get anybody to explain to me the tax implications of why a Delaware C is the best choice. They just assure me that it is. And I'm not going to fight it. Anything about the Delaware C?
But yeah.
Corporate laws and cost.
Okay.
Well, and there's here's my short answer, because that's a can of worms. This is personal opinion, so not advice. Take it for what it's worth. I'm in favor of Delaware C Corp because later on, if you are successful and you have acquisitions and other things, it has more flexibility for you at the board level and in terms of share rights for your shareholders and for your founding team than other states. Thank you. So that's kind of my short answer. I haven't been through too many acquisitions, but when one acquisition in particular, we had a lot of flexibility because we were a Delaware C.
I would add that if you're going to take investors right away, it's better to incorporate as opposed to have an LLC, because the corporation laws, having shares defined and people know what they're getting is much clearer for investors. So when we ran the accelerator, even if the company had already registered as LLC, and within 2 months of being accepted to our accelerator, they had to be a C Corp in order to raise money easily.
Yeah, if you have any plans of raising money, even if you're not sure right now, you think you may bootstrap the whole thing, but if you're successful, you'll raise VC capital or something. If you have any option of doing that, then go with incorporate, become a corporation rather than do an LLC or some other structure. And then and consult a lawyer.
What's that?
In case that's not obvious.
Ask your tax advisor.
That's what I was just gonna say. I'm like, actually ask, not me.
Okay. So the first type of financing that every startup is going to go through is what they call founder, friends, and family funding. And the founder aspect of it is obvious. It's the amount of money that you're going to contribute to your idea. But the friends and family one is a little bit more complicated, and there's a huge weakness in our community for raising friends and family funding. And I don't know exactly why that is, and that could actually be a hot topic, but we tend to think, and when I say we, I'm talking about Latinas and Latinos, we tend to think that there's no available capital in our community, and that is absolutely not true. And so when you raise friends and family funding, what you're letting all investors know further on down the road is that you have the love and trust and that your community wants you to succeed. And you have people that are on the line, or you're putting yourself on the line for the money of all your friends and family. Now, there's a whole argument that can be made that says never get into business with your friends and your family. But every investor that I know of will not touch something that has no investors that are supporting the entrepreneur. And so I would urge everybody in this room to figure out a way to ask your friends and family if you have a great idea and you want them to support you. Sure, you're already going to have all your documentation in order, but they're not going to be investing in you because your idea is so great or your pro forma is so realistic or anything. They're going to be investing in you because they love and they trust you and they want to see you succeed. So I typically, when I look at a startup, I want to see $250,000 in friends and family funding. And so if you want to break that down to something that's manageable, it's trying to create a network of 500 individuals that will give you $500. And so even if you can't get to the 250,000, you don't want to show up at my desk with zero. It just lets me know that nobody loves you, nobody trusts you, and nobody wants you to succeed. Somewhere.
All right, so this is why you have multiple people, because I have a different perspective.
Feel free.
I personally am not a fan of friends and family funding. Now I'm coming from a different perspective. I'm coming from an entrepreneur. I'm coming from the perspective of the hired CEO a lot of times. The reason that I'm not a huge fan of friends and family, I do like founder money. I like when a founder, if you believe in your money, then you should you should believe in your money too. If you believe in your idea, you believe in that there's an actual company there. If I see you investing not only your blood, sweat, and tears, but also your precious money, then that's a good sign. I don't like the friends and family because I prefer when investment is being put into a company, I prefer qualified investors are the ones that are actually investing. The reason for that is because usually working in a tech space, I'm looking for a short time frame and for a big return. And when you have unqualified investors, it creates some extra hurdles for you when you're talking about acquisitions. And so that's the reason that I personally, again, that's not really a do it, don't do it per se. It becomes bothersome, I guess. There are ways around it, but it takes extra funding and extra money later on when I'm trying to get things done structurally within the company. So I prefer qualified investors over friends and family. That also can extend to, when you're talking about friends, that also extends to co-founders. If you're a founder and you have an idea and then maybe you decide to give part of the company to like a developer, software developer or something, that also has some implications down the line. So you have to be aware of that stuff going in at those early stages and make sure that everything's super clear in terms of communication, contracts, all of that up front, especially when it comes to taking money. That is a little bit of a different philosophy. When you're talking more of small business type models that are going to grow over a little bit longer period of time, that's very common where you get family money. I have a couple of small businesses and basically I have a couple of family members that all went in and we started it up. But it's not going to be a $100 million company. It's something that we're going to grow more slowly, and it is a way to create investment so that we can start that small business. So that's just a different perspective.
So I'll take a little bit of the middle road. The reason why San Diego as a startup community isn't as big as Austin or Boston, Seattle, Boulder, San Francisco, is because we don't have the previous generation of entrepreneurs who have made their money and know that they're going to make a bet the same way somebody else made a bet on them because they understand the model, right? What we're trying to do here in San Diego is convince biotech people and Navy people and tourism people to invest, $50,000 in a tech company, right? And unless they come from Qualcomm, they're going to look at you and say like you're crazy. So that's why it's hard to raise money in San Diego, and it's even harder, obviously, if you come from a smaller community. So that kind of generational entrepreneurship still has to develop. So if you're raising that first round, and it's extremely difficult to do, you're better off going to an entrepreneur or going to a group, and it doesn't have to be local, right? It can be across the world of people who've already done what you're trying to do because they'll understand. And obviously, if they did it well, they have the money, and they're a qualified investor. In other words, they'll sit on your board and they'll give you that advisorship and mentorship.
That's a really good point because I just talked to an entrepreneur who had been, I'll loosely use the word struggling. She's had success, but not the success that she was anticipating over the last about 2.5 years. And she had the opportunity to go out to New York, and just what her company is, it's a tech company, but who her audience is, New York was all over it. Like, it was more entertainment focused. Hello, San Diego. Like, you can. I always say you can find anybody, but like she went to New York. She went to LA. Didn't even get it in LA. She went to New York. All of a sudden, like, she's big time. So you have to know where your audience of investors are. That's a good point. Yeah.
Dale, Tyler. All right, finding a co-founder. So last year, I was invited to give a speech at Harvey Mudd College, which is a big engineering college in Claremont. And what I discovered there, which I didn't know existed, is that they are now creating their own incubators and accelerators. And what they do is they say, look, if you get an education here, you now become a part of a team. And if you ever have an entrepreneurial idea, you can come into our incubator or accelerator, and if you convince everybody that it's worthwhile, we will invest $120,000 for 6%. We'll give you office space. We'll give you legal resources. We'll give you an array of successful entrepreneurs and mentors, and a demo day where we're going to introduce you to more. Now, this is just at Harvey Mudd. There are examples of this at all the university systems, some less, some more. But if you're looking for like a technical co-founder, that somebody that can handle the technology and you're more interested in marketing or you're more interested in operations, these are good places to go to because there's a lot of resources that are available for you guys at the university systems. Summer?
You wanna go? You have the actual incubator.
Yeah, so we ran the accelerator for a year, 2 cohorts, 16 companies with pretty much the same model. An entrepreneur will say, I'm giving up too much equity. But the value of the mentors and the program itself is extremely valuable. You really can't put a price on it. So the reason it's called an accelerator is because in 4 months you meet 300, 400, 500 people who are legitimately interested in your success. Whereas if you did that on your own, that could take you 3 years. So if you are considering an accelerator program, I would not get too hung up on the terms, the money, and the equity. I would look at their mentor roster and look at their program and see how much interaction you're actually going to have with them, because those are the people who are going to make you a success.
And in San Diego, there are more than, I think we're getting close to like 24 incubator accelerators locally. Don't quote me on that, but something like that, yeah. So there are opportunities out there. You need to figure out what works best for you. For those that aren't familiar, Connect is a local trade organization, and they have opened an accelerator, I think they're calling it accelerator incubator, called Connect All, which is specifically geared towards serving this community. And so, do you know where it's at? It's just south.
Jacobson.
Yep.
At the so not too far from here, right? And so they're openly looking for startups to support as last I heard, they're not taking any equity because they're looking to support this community.
So, and a quick plug for my co-speaker, I get pitches for cannabis and cannabis periphery companies all the time. And I go, hey, I'm not even going to look at this if you don't allow me to share it with Eric. Because Eric knows a ton more than I do, because he has one of the first 3 is it an incubator?
Accelerator.
An accelerator for that industry. And so those people are really, really helpful. Dale. All right, so these are the stages of venture capital. So this came to me from one of my friends in Canada who runs a VC called Panache Ventures, which is a part of the 500 Startups Network. And so this just gives you an idea of what type of capital you should be looking for at each individual stage. And sometimes, the reason why I sort of focus in on angel investment is because of this little dotted line right here, which is, if you're looking for venture capital because you don't really understand what venture capital is, and you're more at this stage, you're likely to get rejected, and you're likely to get depressed, and you're likely to run into all sorts of problems that either you're going to adapt to or you're just going to give up. And so this slide just exists to let you know where the angels are relative to friends and family, relative to venture capital, relative to an IPO or public equity. Summer, anything you want to say there?
Well, just for those that may be newer to raising capital, just to point out, this is based on your company's valuation, which is different than how much money you are raising, right? So if you're, maybe you know the numbers, I don't know them off the top of my head. Friends and
25%.
family, 25%.
You're giving up 25% in each round, yeah.
Well, I was going to say, like, friends and family, I'm usually looking at friends and family and founders for up to like 250, 500,000-ish. Angel investment, I would say under $1 million.
We go to 3 million on a syndication.
On an angel? On a syndication. If you're syndicating up to 3 million. So I would say, like, for individuals under $1 million, you can syndicate and get more. VC capital, you have kind of super angels, which will do like in the low millions, similar to like a syndication type situation. But for venture capital, over $1 million, 3. I don't know what the current is right now.
$1 million is probably the minimum. they're willing to invest.
That's why I jumped at 3.
Yeah.
Like, it depends, like, I don't know, like, if I was raising $1 million, I wouldn't go VC. If I was raising $3 million, I'd consider VC. But there's some VCs that are making smaller amounts right now because they want to get their foot in the door earlier. But you do have to have traction. You do have to have revenue. You do have to have, you know, if you're a tech, you know, phone app, you have to have 1 million users. Like, there's certain thresholds that you have to meet before a VC will discuss with you. And then I don't know anything about public because I don't work in that space.
Eric, anything about that?
Yep, I'll just add that line on this side of the line, the investors are investing in you. So it doesn't really matter how well the company or the product is doing, they need to trust you. So you're selling yourself. That's why friends and family is so important, and your own personal network, because you don't have a business to evaluate before you hit that dotted line. You just might have gotten a little bit lucky or unlucky. After the dotted line, they don't care who you are. They want to evaluate the metrics of your company, and they want to see the product, and they want to evaluate the industry and the timing, and they're going to throw you out the door.
Yeah, after the dotted line, they're going to throw you out the door.
So that's a huge distinction that a lot of people don't understand, and they still think that on this side of the dotted line, people like them, and it's not true. They just want the money. And on that side of the line, they think, oh, my business is great, and people are saying, well, I don't think you can run the business because I know you. So it's a totally different way to pitch the company.
For sure. All right, dale. So when am I investor ready, and how do I find my lead angel? Well, that's me right there, and that's what I do. And I want to do it for the Latino community. So there's one. I will be the one to tell you if you're investor ready, and I will try to provide you with resources to locate your lead angel, but there are others, and so you just got to find them.
Yeah, I think, so I've done a lot of fundraising, a lot. It's a full-time job, plus the job of running your startup, right? And a lot of it hinges on finding your first investor, your lead investor. There are a lot of places to find that. This is a great place to access your friends and family network, to see who has, you know, the network to qualified investors who could be angels. I would say we could talk, this is a whole topic in and of itself, right? I will say that there's kind of 2 ways of going about finding your investors that I usually coach CEOs on. 1, take any investor you can get. Money's money. Like, that's one philosophy or strategy. Number 2, strategic investors. And again, every company is different. I had a company in which the business model was so complicated, which in my view was why no one had done it yet. There was a lot to it, a lot of moving parts. You gotta have high expertise, all these hurdles. And that's why no one had done it, and I thought that's a great opportunity, we have a great business. But because it was so complicated, it was really hard to find a lead investor. So I got in front of every pitch competition, every incubator. We were in every accelerator, just so that I could get in front of as many, like I would be talking at this event, and then the next event, and then the next event, hoping that there'd be just one person in the room that would be like, I like her, I'm gonna invest in her. The next company, we were very strategic. I had a criteria list. I had 5 core things that my investor had to have. They had to have a basic knowledge base. They had to have this network. They had to, actually that one was specific to this community, in that I needed folks that understood Latin America, because I didn't have time to educate people of the quality of Latin America and where the opportunities were and all of these things. I didn't want to educate. We didn't have time for that. So that means that I had to find investors that had already invested in Latin America, or that's kind of a weird thing to say, but we'll move on. It was relevant, right? So I needed people that met these 5 criteria. If you didn't meet those 5 criteria, I wouldn't waste your time or my time by meeting with you. So you have to make a choice about how you're going to go about, like, raising those funds. Like I said, we could talk about this topic all day long, right?
Eric, you want to add anything?
TCA.
This is the hardest thing you'll ever do, so hire said him. I'm not joking. This is the hardest thing you will ever do.
This is one of the reasons usually people end up hiring me, like with a lot of my startups, is because they've started fundraising. Like they're confident about their product and about what their service or whatever is, and then they haven't had the experience before, and so they don't know what they don't know. Get out there and just start talking to people. You will learn so much faster than kind of dragging your feet on it. So yeah, to Eric's point, this is, like I said, a full-time job. It's tough. But you can do it.
All right. So this one, Eric mentioned it, but we could do a whole speech on just this. Of the 1,000 startups that I've seen, probably 980 show up and give me marketing decks. And that's like, let's just say for the sake of argument that you have an app, your company is developing an app, and you're trying to showcase how you're going to get people to utilize the app. I have no interest in that whatsoever as an investor. I want to know for how much money I'm going to give you, how much are you going to return to me and in what time frame? And so make sure that you don't show up. You're going to need a marketing deck when you have to go and showcase your idea to potential consumers. But when you're with an investor, make sure that you have an investor deck. Summer?
You can literally Google this, go to any accelerator website. Almost everybody posts them now. I give speeches about this, talks and workshops about this topic all day long, about how to position an investor deck, what should be in it, what shouldn't be in it, how to communicate it, how to pitch it. You should be spending considerable investment of your time in doing this. I think what your point is, as it relates to not a marketing deck, a lot of companies get started because someone has a good idea about a product or a service that they want to make, and then the deck ends up describing the product or the service instead of describing the business. So that's the distinction. You need to be talking about what the business model is, and what the business is. The product or the service is a component of that. Okay, so that's what an investor deck is. And then the other piece I'll make is, because you mentioned the greed of the angel, right? So what you're saying there is, don't forget to say how someone's going to make money. We said that earlier. My general thesis is that try to figure out what the investor wants. I don't care who it is, friends and family, whomever. They're not going to be as excited about the company as you are. You should be passionate about the company. If I go to Eric and I say, Eric, I have this amazing idea, come invest in my company, I'm going to be more passionate than he is because he just learned about it and he's not spending his life doing it like I am, right? However, the reason that he's going to invest in me, again, this is my thesis, 4 reasons. Greed kind of going along with return on investment. There are some folks that are just interested in rolling the dice and getting a return on investment. Some investors will actually invest because they're trying to support a specific cause. So in this case, maybe it's an investor who's trying to support the community, and so they're specifically looking for investors like Latinos in order to invest in. So there's a component of, oh, I see something that I can help support. Another one is, and this is one of my favorites to go after, the lawyers, the surgeons that have great high-paying jobs that have been doing it for a long time. They make a lot of money, but they have this entrepreneurialism about them. Like they've always wanted to start up a company, but they're not about to leave their high-paying good job that they're very happy with. And so they invest in you because then they get to live vicariously through you. They get to like have the experience of being in a startup without having to quit their high-paying job to start their own, right? And then 4th, and I get this occasionally but less often, someone has done it. Eric mentioned we don't have as much of it here in San Diego, but someone has done it, and by done it, it doesn't have to be a startup. They've done something where they've had success, and they want to pass that on, and so they see something in you that reminds them of themselves, and so because of that, they want to have somebody else support somebody else in their pathway. So what I do when I approach an investor is I kind of do my own analysis in my head to try to figure out, what do I think this guy's motivated by? So if I were to approach you, I would go, okay, I get that he's really into the financials, Like, he wants to know he's gonna make money, so I'm gonna spend extra time on the financials. And then I also know that he's interested in the Latino community, so I'm going to really emphasize the part about how this will help the community or how we can represent the community in order to have more of a voice. So I would focus on those two things more than like, oh, I'm just like you. Like, I wouldn't do that because that's would be a distraction from the pitch.
Sure.
Along the same lines, you'll end up with 50 versions of your deck, marketing and investment. So don't stress about it too much. Tailor it to the audience, and just keep progressing. Don't get stuck on it.
So to Summer's point, we've had a success in the, 2 or 3 years ago with a Latino named Isaac Saldaña, and he started a company called SendGrid, and they were able to get to IPO. They've been able to do really well. Major corporations are using it, and now he's joining Techstars to help the next crop of entrepreneurs. And so, but we don't have that many stories like that. They don't exist. And so
Yet.
they
don't exist yet.
David. All right, so I'm gonna talk about this now. So there's an entity in Orange County that's called Octane, and Octane's claim to fame was that they supported Oculus when Oculus was nothing. And you can go, anybody in this room can go to Octane through their Launchpad service and ask for support on how to craft a deck, how to perform a pitch, et cetera, like the whole gamut of everything that you need to get investor ready. And for the most part, I've sat in the rooms with the startups that I've gone in, and so what they do is before you get into the room to do your pitch, they let you know this is what you need to have in your deck. But then once you're in the room, it's the first time that they're actually hearing you pitch your deck. And those are two totally different things. Like, one is one thing that's on paper, and the other is how you present yourself. And I would say, and I have no idea what this statistic is, but like 75% of entrepreneurs that think they're investor ready are engineers. And engineers sometimes don't have the most charismatic personalities. And so these guys get thrashed. And so what you have to remember is that, once you have your deck, that's not the only thing. Like, the information that's on the deck is not the only thing. It's also how you present it. Summer. You're an engineer, aren't you?
I am. I'm a bioengineer. So there's, I don't even know where to start.
I'll give the investor standpoint.
Okay.
If you're an investor, don't be fooled by the pitch. There are people that raise a ton of money and they lose a ton of money because they're able to go to an event like this. They sound great, they're confident, they know all the words, they're smooth, they answer everything in a great political manner. People throw checks at them and then, without like looking under the hood. So if you are great at pitching as an entrepreneur, make sure you're qualifying those investors and make sure they understand what they're investing in. If you're a terrible person at pitching, and I'm one of those, you may want to tailor your presentation to just getting the attention of that person and then explaining yourself in a room one-on-one, or maybe you're better at communicating. So the pitch is always just to get the next meeting. That's the goal. No one hands you a check after a pitch deck. Well, some young investors do. But usually you have 3 more meetings with that person. So you just have to get their attention.
And I'll say, it reminds me of what you just said. An investor invests in you at an early stage. So the pitch deck is a mechanism to communicate. I've seen people where they put their slide deck together and then they're sitting with the investor and they're literally like reading off the slide deck, right? And there are different, well, let me go off that first. They're reading off the slide deck, you need to be having that communication, right? I need to be having a conversation. The objective is to overcome all of the objections or address all of the risks that they perceive may be in the investment, right? And then the second piece is there are different types of pitch decks. And this is something that I speak on quite frequently. There's the pitch deck that you get 2 to 3 minutes on a stage and you pitch to a room and an audience and there's not as much substance in it. Then there's the pitch deck that you maybe have 10 minutes in a room, like a conference room full of folks. Maybe TCA is a good example of that, the Tech Coast Angels. When their venue, you'll go in and pitch to, I don't know, up to 15 people in the room on the first round, and then it expands from there. And then there is the, kind of longer one-on-one deck where you potentially, like if I was gonna pitch to you, I might include financials, whereas I might not include financials when I'm up on a stage, right? In fact, I very rarely do. So there's different types of pitch decks. Octane's great, Octane up in LA County. There are tons, like I said, there's like 24 different organizations here in San Diego, and actually, I didn't even think of mentioning this, and in Tijuana, that will help you with your deck and communicating those messages for investors. People like Eric come in and you go in, it sounds like, and help those investors hone that pitch deck in. So use it as a tool, not as the end all.
Sure. So, but the thing that I want people to recognize from this slide is practice makes perfect. Keep on practicing it. Eventually, it'll be like second nature if you practice it enough. And that the Small Business Administration and the Small Business Development Centers have a lot of free resources for everybody in this room. It's just whether you utilize them or not. Is anybody here friends of Marquise here in San Diego? Okay.
You can also YouTube it, like literally YouTube elevator pitch, and you can see people from Silicon Valley like everywhere because there's many different styles of giving pitches as well.
This one's tough to talk about within the time frame. I've provided Taide with a Google Drive filled with documents for anybody in this room to have, and one of the documents in there is the basic term sheet that my angels use. And what I wanted to touch on, however briefly, is this is the financial aspect of a term sheet. And each one of them deserves like a good 30 minutes of sort of detailing. But this part is really, really important to the investors because it's really how you develop your relationship with your investor. And so you need to understand them. So this one obviously is the amount that you're asking for an investment or the amount that the investor is giving to you. Valuation cap requires a long explanation. Term is just the time frame in which the investment is handled. Rate, that's a dirty little secret that I don't even know if I should touch on.
Well, first of all, this is a convertible note. So this is a debt instrument that is meant to convert into equity at the term or the next equity financing is met. So this one's much more complicated than just here's a share price, here's the price, right? So this one, a lot of people will never understand, or a lot of entrepreneurs are just not meant or programmed to understand this stuff. Make sure someone on your team is. Someone on your team has to know how to go through this really quickly and change terms quickly and understand the factors.
For sure. This one requires a lot of explanation, and I'm even getting tripped up right now trying to figure out how to release it to you guys. But those are the financial elements within a term sheet, and they need to be understood. And email me if you need help.
Well, and just to add on that to what Eric said, there are different types of term sheets. So these are the elements of a term sheet for a convertible note. The one thing that I'll say for entrepreneurs, it's great, like having a resource, like you said you had some resources available. Use those to teach yourself and to understand like how different ones are structured. But I personally would discourage anyone from doing it themselves. This is one of those things you've got to get a lawyer involved in this and you need to explain to them what your intentions are, and then get them to draft up what it is for you. And you don't have to have some big wig, really expensive attorney, but you do need to get a lawyer that has worked with startups before, so that they understand where you're headed. Or if it's small business or whatever it may be, if there's some sort of specialty, make sure that you get someone that's a good fit to advise you, because this stuff will come back and bite you into the butt. This is where you get your horror stories, where you gave a co-founder equity and then they decided they didn't like you anymore, and like all the horror stories originate from someone signing a contract that they really didn't understand at the beginning.
That's right. And on that note, like, I wouldn't be ashamed of that ignorance. So there's a program on NPR that's called How I Built That, or How I Built This, or something like that. And if you listen to the one from the guy who founded Atari, you will hear the most entertaining story you've ever heard in your life, but you'll also hear how Steve Jobs offered him Apple for, I think it was less than $50,000 for 50% of Apple. And so everyone goes through their stages of ignorance, right? And so, and the guy didn't take it.
I was gonna say, anecdote, that's the same guy that did Chuck E. Cheese.
It's a really entertaining story.
Isn't it interesting?
On a Latino footnote, of the 81 episodes, roughly thereabout, I did my research last year, there's only been one Latino that's been featured on that show.
What was the name again? The show?
How I Built That?
This.
How I Built This. Dale, dale. All right, so now, after all these things that we've gone through, if you were investor ready and you were developing your startup, you would have all your documentation, you would have your channel partners to help you with sales, you would have your team that it's each one handling different aspects of the startup, you would have your letters of intent with clients, you would be capitalized, you would be releasing your minimum viable product, and then you would be gaining traction for 2 to 3 years, when at the end of that, you would typically be going in for your next round of financing. And that's, if you're raising an angel round, typically they would want you to go on to the venture capital round. But I'm not recommending that that's the case. If you can sustain your business after the angel round, I would recommend that. Summer.
You nailed it.
I don't know.
That's,
Third
yeah,
question?
that'd be great if you could.
Yeah, that's a
simple.
pretty good list.
One thing I would add is you're going to listen to everybody's advice, right? But you'll notice that even in this panel, there's two diverging thoughts on what you should do as an entrepreneur. So take everyone's advice, digest it, and then make it into what's best for your company. No one investor is ever going to tell you everything perfectly, so take it as a crowd advice when you're an entrepreneur. Okay.
Oh, I can comment off of that. Because on the other side of it, for the CEOs, when I coach CEOs, don't listen to everybody's advice. Because I see that happen sometime where someone goes, oh, well, I'm trying to be coachable. Okay, being coachable is very different. You don't want to dig your heels in and say, no, this is how my vision is and this is how it's going to be. You need to take the advice, but you've got to figure out, you've got to listen to what everybody says, and then you've got to figure out what advice to take. Otherwise, you're going to be going around in circles chasing your tail, because the investors will tell you different things. I give the analogy that it's kind of like being like an actor or an actress, and you go in for an audition, and you go into the first audition, and then the person goes, you're too skinny. And then you go to the next one, and they're like, you're too fat. And you're like, I'm the same size. You're too white, you're too ethnic, you're too this, you're too that, whatever it is. And then finally you walk into that one person, and they're like, oh my gosh, you have the part, you're brilliant, you're just what I've been looking for, you fit what I want to invest in, right? So you're gonna get a lot of different feedback, because people come from different backgrounds and are looking for different things when it comes to investing. So don't take everybody's advice, listen to everybody's advice, and then figure out what you're going to kind of follow. That's the key and the differentiation between a good CEO and not a good CEO. And then, I know I'm saying a lot, but I want to add one more thing on there. Nobody knows your company better than you, right? An investor can give you all kinds of ideas, and they can give you great advice. They're a wealth of information, but nobody knows your company like you do. So you have to take the confidence in that, and then make it better and make improvements so that you can attract the investment.
Okay. Other thing that I would mention here, because I've been working with technology startups, is, and this is a can of worms, but a lot of times people will come to me with having friends develop their apps for them, and they burn through like, you know, $100,000, $200,000, and it's really unusable. And so they skipped all of this stuff and they went straight to development. And so I would urge people to be very cautious with at what moment do you start developing your technology company, because software development is very, very expensive. And if you don't have something that's capable of scaling, meaning the infrastructure of your code is not capable of scaling, there are a large amount of investors that are not going to invest in it because they know it needs to be rebuilt.
It's always like the chicken or the egg kind of situation. You need to remember that you're not building just a product, you're building a company. So you have to find the balance, and again, every company is different. So the timing, one company, you'll need, you know, MVP, maybe it doesn't really need to work or be pretty, it just needs to function. You just need to apply your algorithm and you're done. Later you can make it pretty. Other times you need to get users, you don't even need to have the product done, you can just get the users and kind of glue and band-aid it together to make it work. So every company is different. It's your job, that's one of your jobs as CEOs, to find that balance and figure out how much company you're building and how much product you're building. Because at the end of the day, you need to have a business model. That's what you're building, not just the product, not just the service.
Okay, so because I was a writer, I love these stories of people that utilize media as a way to raise capital. And so there's this dude in Los Angeles now. His name is Sam Koch, and he was a hedge fund trader in New York. And he decided one day, I mean, it's a ridiculous story, but he decided one day when he was offered a $3 million bonus that was an insult, and he quit. And then he went to Mexico, of all places, and he started to do a type of therapy. It was like a primal scream therapy. And when he came back, he approached the publisher in New York and said, I want to tell my story of how I was the biggest jerk of all time from birth until now, and now how I'm going to make amends for no longer being a jerk. And he published this story with this New York publishing house. It's called For the Love of Money. And it did well. And it did well enough that when he started to tell people what his idea was, which was it's a nonprofit in Los Angeles that used to be called Grocery Ships, and now it's called Feast. It was like he was going into food deserts in Los Angeles, and he was providing some type of wisdom that merited having a nonprofit. And then he turned it into a for-profit company that's called Every Table. And Every Table right now they started with one store near USC, and they now have 7 stores. But in between that time, he hired a really expensive premier New York PR company that you have to get accepted for them to even want to work with you. And then they put him on the cover of every magazine and every newspaper and everything. And then he was able to raise the amount of capital that he needed to at least have 7 stores and some money in the tank to build the rest of the stores. He also went on Shark Tank, and it's one of the weirdest Shark Tanks I've ever seen, because it was an investor that I'd never seen before. Maybe I don't watch it enough, but he wasn't one of the regular investors, so it was almost like he was put in there just for this particular investment. And then it was like he was giving him $1 million for like 10% of the company, which the $1 million was not really going to do much. And so it felt to me like it was a publicity stunt, but it worked. And so again, NPR, how I built this, the majority of the stories that you will hear, if you have the patience to listen for the whole hour, there will be a moment when they say, oh, and I got picked up by the LA Times, by the New York Times, by Wall Street Journal, etc., and the whole thing exploded. I just heard the one from Tom's, that was like that one. I just read, I heard Laura Barr. All of them have the same story. The minute that you can get media to support you, there's a high probability that your startup will grow exponentially.
To that point, when you work with a PR firm, if you're able to even get that far, make sure that you and them are clear on the motivation behind the press release. So the press release should be released not to like congratulate yourself or you know, just out of vanity, right? It should be for a purpose, because as soon as that press release goes, you're gonna get a ton of incoming calls. So if you're trying to raise money, make sure you have all your investor docs ready, make sure you have the people there that can answer the phone and take the meetings. So, you know, just like attending an event, right? It doesn't end after you attend the event. After the event is when the work starts, because you have to follow up with everybody and make sure that attending that event was worthwhile. So the common mistake that we see a lot of people make with publicity.
That's right.
Yeah, and I'm usually involved too early in a company that we'll even consider PR, because PR is a big cost. There's ways to get free PR for sure. I would say that I'll give my advice in terms of a caution, is that it's great. I've had friends that have gotten good PR, even unexpected PR, because someone really liked their app or really liked their company or some, you know, success story, and then they've had so many visitors to a website or so whatever it may be that their system crashed, and then they weren't able to take advantage of it. So you spent a lot of resources investing in getting the PR, and then you weren't able to monetize any of it, and not only that, it potentially can cause a huge fallout for you and your team. There was a similar story of someone I know that was featured on Oprah, and they worked, I mean, their team worked for like 2 solid years trying to get on Oprah, and finally got on Oprah, and it crashed their site because they had even ramped up. They knew they were going to be featured. They had everything in their mind lined up. It crashed. They couldn't keep up with production. It essentially killed the company as a result of PR. So there's both sides of PR. There's this like general thought, like, you know, any press is good press. That could be true, but you need to make sure that you're preparing for it. The journey of getting the PR is not the end-all be-all. You need to be able to monetize it at the end. That's why you're doing it, is to monetize it. If you can't monetize it, then you're wasting your time.
So, and there's a lot of wisdom for anybody who might be a product entrepreneur. I think they call it the Costco effect. Like, you think, oh, if I could only get into Costco, and then you find out what the terms are for getting into Costco, and likely you can't handle it. And so,
If you want to know what the terms are, you can ask Christina.
It's gnarly. So you got to be prepared for when you get that moment to shine. Dale. Oh man.
There you go. You had it.
I don't even know how. So again, this one is similar to the term sheet. So this is kind of a summary of where people go, and people get crazy here. Like in my world, I don't differentiate between pre-seed and seed, but a lot of people do, including this guy that I got this from. And I definitely, all of this to me is seed. Summer, do you disagree or agree?
No, I would say that's pretty on track. I think there's some differentiation that's happening right now where the people typically, in my world anyway, the pre-seed typically means that you don't really have a lot of traction or anything yet, like you're really early. That would be more seed in my world, and then 1 to 3 million is what I see as being called super seed now, or early VC. Like maybe, because I mean you can still do a Series A in the 2 million if you want, but I think most VCs are looking at as like more super seed. So, but it's similar. It's all semantics.
Yeah, and this is available to you guys in the Google Drive. So if you ever wanted to understand it and get more details on it, you guys can refer to it. But this was like a summary page, and from the perspective of one individual investor. Dale. Ya se acabó. Okay. So. want to open it up for you guys to make comments, questions, or to tell us about yourself. Or Daide, you want to moderate?
No, go ahead.
Oh. Yeah, any questions? Comments? Guys, take advantage. Oh, one,
If we have everything that you said you're looking for, how do we contact you or what's the best way to go along?
Me?
I don't invest, sorry.
No,
So I have a Google form. It's tinyurl.com/intolatin. INTELATIN. And that's how I like my information. And so you can put in all the fields. It's like roughly like 10 fields. And then I will connect with you and let you know my thoughts.
Now we'll share with you guys the URL. Right?
So, me?
Yeah.
Me? Okay. So I'm kind of, it's a similar question, but in between. I've been working on my company for over a year, but just recently started putting all these together. I feel like I have many items that you mentioned there, but probably not everything. So I started going to the entrepreneurship community in the city to, like you say, listen to advice, network, find investors. And my question is like, how do I find a mentor? Like you say, okay, I don't think I'm ready, but I have a lot of the vision in my head. So how do I get probably someone like you to say, how can I get your expertise or your help to finish the holes that you may want to see?
Well, so there's a lot of resources for you, starting with Daide, going to me. The small business development centers have a lot of free resources for you. A lot of people there. So there's one man here in San Diego. His name is Dr. Martin Kleckner. So if it's a scientific idea that is worthy of SBIR, STTR funding, like he's the expert in the United States, and he's free. And so, and like him, there's others that dedicate themselves to whatever industry you're in. And so, start with Daide or come to me, and
You can also
Eric,
go
if you have a
to-
cannabis
you can
idea, go to Eric.
Yeah.
I do mentoring. I do it primarily through the University of San Diego, but I'll see if I can, if I can do anything. If I see something that I can help with, because I have the right contacts, or if it's in an industry that I've invested before, I've done something before, I can at least send you to the right person, and I can tell you what's missing. And
Here's what I would say.
and you can reach me through Tide.
All right, awesome.
Okay.
Oh, well, I was just gonna say, here's what I would say is, do you want a mentor or are you looking for investors? Because those are two different asks.
Mhm.
So if you're looking for a mentor, then you need to find another CEO person. Again, my personal opinion, take it or leave it. Find another CEO who has already walked that path. And especially if they have some sort of similarity in terms of like your business concept. I did that with someone who I actually have a CEO friend who I mentored for one of his startups. Then I went to my next startup and he actually almost essentially became my mentor.